Reports indicate a silent, relentless force erodes the wealth of everyday Americans. This isn't theft in the conventional sense. It's a systemic drain, often overlooked, directly impacting savings and future security. Sources suggest millions struggle to build meaningful financial foundations, despite consistent effort. Our investigation reveals a critical factor: the taxation of hard-earned money, compounding year after year. For many, this constant erosion feels unavoidable, a fixed cost of living. But is it? We probe the hidden mechanisms at play, examining how unchecked taxes redefine futures. The stakes are profoundly human. Consider Maria, a nurse in her late 40s. For years, Maria diligently saved, placing funds into a standard savings account. She believed she was doing everything right. Public records and personal accounts reveal a stark reality: her modest gains were consistently undercut. Every year, it felt like I was running in place, Maria states in an interview. The taxes on my interest just ate away at any real progress. Economic analysts confirm this pattern. For Maria, this meant a lost decade of potential growth, a decade where inflation and taxation combined to diminish her purchasing power. Her story is not unique. Yet, a different path exists, often obscured by financial jargon and perceived complexity. Sources indicate specific financial tools, often termed tax-advantaged accounts, are designed to legally mitigate this tax drain. These are not loopholes for the wealthy, they are government-sanctioned incentives, accessible to nearly anyone. Our investigation uncovers how these accounts function, offering a shield against immediate taxation, or even eliminating it entirely on growth. The government, according to policy documents, uses these as incentives for long-term savings. Understanding them is the first step in reclaiming financial ground for individuals like Maria. A pervasive myth, often cited by individuals avoiding these accounts, is their perceived complexity. Many believe these tools are exclusive, requiring specialist knowledge or substantial wealth. It all sounds like a foreign language to me, admits David, a construction worker we interviewed. However, financial literacy experts challenge this narrative. They state that while the underlying mechanisms can be intricate, the practical application for everyday users is often straightforward. This myth, our probe suggests, prevents countless individuals from accessing significant financial benefits. It's a barrier of perception, not necessarily reality. Our inquiry begins with the 401k, a cornerstone of retirement savings for many. This employer-sponsored plan, widely available, allows pre-tax contributions. This means money goes into the account before income tax is calculated, immediately reducing taxable income. Sources at the Department of Labor confirm these contributions grow tax-deferred, meaning no taxes are paid on investment gains until withdrawal in retirement. This deferral allows for substantial compounding over decades. For employees, the 401k often includes employer matching contributions, effectively free money, a powerful incentive often left untapped by workers who are unaware or intimidated. Meet Sarah, a recent college graduate starting her first corporate job. At 22, she earns a modest salary. Her employer offers a 401k with a 3% match. Financial advisors consistently recommend maximizing employer matches. Sarah initially hesitated, citing student loan debt. However, after reviewing company literature, she allocated just 3% of her income. That small initial step, according to projections from financial modeling firms, could translate into tens of thousands of dollars in employer contributions alone over her career. This early adoption significantly alters her long-term financial trajectory, demonstrating the power of even minimal contributions and matching. The core benefit of the 401k, the tax deferral, warrants closer examination. Consider two identical investments, one in a taxable brokerage account, one in a 401k. Sources indicate that for the taxable account, every year, taxes are levied on interest, dividends, and capital gains. This reduces the base upon which future returns can compound. In contrast, the 401k allows all gains to reinvest untouched by annual taxes. This uninterrupted compounding, financial studies confirm, creates a significantly larger sum over time. The difference is not just numerical, it's exponential. It's the silent multiplier at work. Another common misconception is that these accounts are solely for distant retirement, trapping funds until old age. While retirement planning is a primary function, our investigation reveals nuances. The 401k, for example, offers provisions for early withdrawals in specific, documented hardships without penalty, such as unreimbursed medical expenses or a first-time home purchase, though income taxes still apply. Experts advise extreme caution, as the primary goal remains retirement security. However, the blanket myth that funds are entirely inaccessible is misleading. Understanding the rules is crucial, as is careful planning for life's unexpected turns. Beyond employer plans, individuals have powerful options. The Individual Retirement Account, or IRA, offers flexibility for nearly everyone. Sources indicate two primary types, traditional and Roth. A traditional IRA functions similarly to a 401k for tax purposes. Contributions may be tax-deductible, and growth is tax-deferred. Withdrawals in retirement are then taxed. This option can significantly lower current taxable income for many. The IRA is a vital tool, particularly for those whose employers don't offer a 401k, or for those seeking to supplement existing plans. It represents a direct personal investment in one's future. Mark, a self-employed graphic designer, embodies the utility of the IRA. Without an employer-sponsored 401k, Mark worried about his retirement. "I thought I was on my own for savings," he recounted. Our investigation shows that after consulting with a financial expert, Mark opened a traditional IRA. He now contributes annually, directly reducing his taxable income as a sole proprietor. This deduction, confirmed by IRS guidelines, has tangible benefits. It's allowed Mark to save for retirement while also lessening his immediate tax burden, a critical balance for small business owners navigating fluctuating incomes. The IRA bridges a significant gap. Then there's the Roth IRA, a revolutionary concept gaining immense popularity. Unlike its traditional counterpart, contributions to a Roth IRA are made with after-tax dollars. This means there's no immediate tax deduction. However, the payoff is substantial. All qualified withdrawals in retirement are entirely tax-free. This includes both contributions and all accumulated earnings. Financial data suggests this is particularly attractive for younger individuals, like Sarah, who expect to be in a higher tax bracket in retirement. It's a strategic bet on future tax rates, offering unparalleled freedom from taxation when income is often most critical. Choosing between a traditional and Roth IRA is a pivotal decision, prompting frequent debate among financial strategists. The core difference lies in when taxes are paid. With a traditional IRA, you get a tax break now, but pay taxes later. With a Roth, you pay taxes now, but enjoy tax-free withdrawals later. Economic models consistently show that the better option depends on an individual's current income, anticipated future income, and tax bracket trajectory. There is no universally superior choice, sources indicate. It's a personal calculation, requiring careful consideration of one's financial life cycle. Both, however, offer significant advantages over taxable accounts. Our investigation also uncovers a powerful, often underutilized, tool, the Health Savings Account, or HSA. This account is available only to those with a high-deductible health plan, HDHP. Sources confirm the HSA's triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. This makes it, according to some financial analysts, the most powerful retirement account disguised as a healthcare account. Unlike a flexible spending account, FSA, HSA funds roll over year to year and are portable, belonging to the individual. It's a strategic resource for both current and future medical costs. Maria, our nurse from earlier, began utilizing an HSA after switching to an HDHP. She recounts, "I was worried about the higher deductible, but the HSA changed everything." She contributes a portion of each paycheck, much like her 401k. The funds, now growing tax-free, act as a crucial emergency fund for unexpected medical costs. More importantly, financial planners advise that once Maria reaches retirement age, the HSA can function like an additional IRA, with withdrawals for non-medical expenses subject only to income tax. This hybrid nature provides a robust financial buffer, a shield against escalating healthcare expenses in later life. A prevalent myth surrounding HSAs is that they are only beneficial for those with frequent medical needs. This is demonstrably false. Our investigation reveals that for healthy individuals, the HSA can be an even more powerful long-term investment vehicle. By minimizing current medical expenses, healthy individuals allow their HSA funds to grow untouched for decades, maximizing the tax-free compounding. Sources confirm that unused HSA funds never expire, making them ideal for covering large, unpredictable healthcare costs in the distant future. It's an investment in future health, regardless of present condition. Beyond retirement and healthcare, tax-advantaged accounts address another significant life expense: education. The 529 plan, established by states, provides a dedicated savings vehicle for future education costs. Contributions grow tax-free, and withdrawals are tax-free when used for qualified education expenses, including tuition, fees, room and board, and books. Financial studies highlight its immense value, particularly with the escalating costs of college and vocational training. While contributions are generally not federally deductible, many states offer a state income tax deduction for contributions, providing an immediate incentive for saving for children or even personal education. David and Emily, parents of a toddler, exemplify the 529 plan's impact. They opened an account shortly after their child's birth. "We knew college would be expensive," Emily states, "but starting early with the 529 made it feel manageable." They contribute a fixed amount monthly. Our analysis shows that consistent, early contributions, combined with the power of tax-free compounding, can dramatically reduce the need for student loans. This lessens the future financial burden on their child. The 529, according to government data, now helps millions of families make higher education an achievable dream, not a crushing debt sentence. A misconception persists that 529 plans are exclusively for saving for a child's education. This is incorrect. Investigations confirm that beneficiaries can be anyone, including the account owner themselves. Adults returning to school or pursuing vocational training can establish a 529 plan for their own educational needs. Furthermore, funds can be transferred to another eligible family member without penalty. This flexibility underscores the 529's adaptability beyond the traditional parent-child dynamic. It's a tool for lifelong learning, available to a broader demographic than commonly assumed, challenging previous assumptions. Our core investigation circles back to the true cost of inaction, the compounding crisis. When funds are left in taxable accounts, yearly taxes cut into the principal's growth. This might seem minor in the short term. However, financial models demonstrate an exponential divergence over decades. A hypothetical $10,000 investment growing at 7% annually, taxed at 20% each year, will yield significantly less than an identical investment in a tax-advantaged account. The missing money isn't just lost, it's the potential future wealth that never materialized. This is the silent tragedy affecting millions. To illustrate the profound impact of tax-advantaged growth, consider these figures. A $500 monthly contribution over 30 years, earning a hypothetical 7% return in a taxable account, could yield approximately $450,000. The same contribution in a tax-advantaged account, shielding those gains from annual taxes, could reach over $600,000. This $150,000 difference is solely due to the absence of annual tax drag, according to financial projections. This is not speculative, it's a measurable, demonstrable outcome of utilizing these financial structures. The numbers speak for themselves. Why does the government offer these tax breaks? Our analysis of public policy documents suggests a clear agenda. By incentivizing long-term savings for retirement, healthcare, and education, the government aims to reduce future reliance on public assistance programs. A financially secure populace is less likely to strain social safety nets. This self-interest from the government's perspective creates a powerful alignment with individual financial goals. It's not charity, it's a calculated move. Therefore, understanding and utilizing these tools is not merely a personal benefit, but also, indirectly, a participation in broader economic stability. The primary consequence of delaying participation in tax-advantaged accounts is irreversible. Once a year passes, the opportunity for tax-deferred or tax-free growth for that period is gone forever. This loss isn't just the missed tax break, it's the compounding returns on those tax-protected dollars. Financial experts consistently emphasize time as the most valuable asset in investing. Delay is the most expensive mistake, states Dr. Evelyn Reed, an economic professor, in a recent publication. Our investigation confirms that every year of inaction represents a significant, tangible opportunity cost for an individual's financial future. Despite the urgency, our findings indicate that dramatic leaps are not required. The power lies in consistent, small steps. Starting with even minimal contributions, as Sarah did with her 401k, initiates the compounding process. Many accounts allow contributions as low as $50 a month. Financial coaches advise that consistency, not large sums, is the bedrock of long-term wealth accumulation within these structures. The perception that one needs substantial funds to begin is a myth. The reality is that starting small, and starting now, vastly outweighs the strategy of waiting for a perfect larger sum. It is important to acknowledge that these accounts are not limitless. Government regulations impose annual contribution limits, which vary by account type and are subject to change. For example, the IRS sets limits for 401(k)s and IRAs, designed to prevent excessive tax sheltering by high-income earners. These limits, detailed in IRS Publication 590A, are periodically adjusted for inflation. While some view these limits as restrictive, experts argue they ensure the equitable distribution of tax advantages across the populace. Understanding these caps is crucial for maximizing benefits without incurring penalties. The advantageous nature of these accounts comes with guardrails, rules and penalties. Early withdrawals from retirement accounts, prior to age 59 and a half, generally incur a 10% penalty in addition to income tax, as outlined in IRS Code. Similarly, non-qualified withdrawals from an HSA or 529 plan may be subject to penalties and taxes. These rules, financial regulators assert, are designed to reinforce the long-term intent of the accounts. While strict, they serve to protect the system's integrity and discourage misuse. Awareness of these penalties is essential for effective, compliant financial planning. The existence of rules and penalties sometimes fuels another myth, that these accounts are so burdened with complex regulations they're not worth the effort. Our investigation contradicts this. While understanding the nuances is necessary, the basic principles for ordinary use are straightforward. Most people will never encounter complex penalty scenarios if they adhere to the primary purpose of the accounts, long-term savings for their designated goals. Financial education initiatives often simplify these rules into actionable advice, making them accessible. The perceived difficulty is often greater than the actual operational hurdles. For many, the most accessible starting point is an employer-sponsored plan like the 401k. If offered, financial experts universally recommend prioritizing contributions, especially to capture any employer match. This is, in essence, guaranteed returns, often a 50% or 100% immediate return on investment. Ignoring an employer match is comparable to turning down free money. Our probe indicates this single action can significantly boost an individual's financial trajectory with minimal effort. It requires only a discussion with an HR department or a few clicks on an online portal. Simplicity meets high impact. After maximizing employer contributions, or for those without an employer plan, the next critical step involves opening an IRA. Financial institutions across the country offer both traditional and Roth IRA options. Many allow online account setup within minutes. Our investigation shows that the choice between traditional and Roth should align with individual tax expectations. Consulting a free online tax calculator or a basic financial guide can often illuminate the best path. This step provides an individual with independent control over their retirement savings, supplementing any existing plans or forming the primary savings vehicle. For those with specific needs, the HSA and 529 plans offer targeted advantages. If you're enrolled in a high-deductible health plan, prioritizing an HSA is a strategic financial move, as discussed. For families planning future education, the 529 plan is unparalleled. Our analysis emphasizes that these accounts are not mutually exclusive. An individual can simultaneously contribute to a 401k, an IRA, an HSA, and a 529, layering their tax advantages for different life goals. This multi-account strategy, while initially appearing complex, is fundamentally about optimizing every dollar for its specific purpose. While self-education is crucial, professional guidance remains an option for those seeking personalized strategies. Certified financial planners, CFPs, can offer tailored advice, navigating the intricacies of tax law and investment choices. Sources indicate that initial consultations are often free. However, our investigation also reveals a wealth of free resources, government websites, reputable financial blogs, and nonprofit organizations offer robust, unbiased information. The key is to seek out reliable sources. No one needs to navigate these waters alone, regardless of their budget for professional advice. A critical component of this journey is trust in the information, and trust in the system. Our investigative approach aims to provide fact-based insights. The tax-advantaged accounts discussed are not speculative schemes, they are enshrined in federal law, monitored by regulatory bodies. They have decades of proven utility. While political winds may shift, the fundamental structure and incentives have remained remarkably stable. This stability should inspire confidence. The tools are robust, the challenge is in understanding and engaging with them. Trust in their proven track record is warranted. Let's revisit Maria. After learning about tax-advantaged accounts, she adjusted her financial strategy. Her 401k contributions increased, and she began funding an HSA. It felt like I finally took control, she says. Our analysis of her hypothetical projections shows a marked improvement in her retirement outlook. The lost decade of tax erosion is now being aggressively offset. Her story is a testament to informed action. It shows that even mid-career, significant changes are possible, shifting from a passive acceptance of tax drains to an active strategy of wealth building. Her future is visibly brighter. Sarah, the young professional, continues to contribute to her 401k and Roth IRA. She's building a robust financial foundation at an age when many are simply starting. Her early commitment, though small, means she is leveraging the incredible power of time and compound interest in a tax-efficient manner. Financial models project her path leading to an early, comfortable retirement, or the flexibility to pursue passions outside of traditional work. Her experience confirms that starting early, even with limited income, provides an almost insurmountable advantage over those who delay. It's a testament to foresight. Mark, the self-employed designer, has found stability through his traditional IRA. He now feels a sense of control over his future, knowing he's actively reducing his tax burden while saving for retirement. This has allowed him to reinvest more into his business, a dual benefit often overlooked. It's not just about retirement, it's about making my business more sustainable now, Mark explains. This interconnectedness of personal finance and business growth highlights the holistic impact of tax-advantaged strategies. His financial journey is now one of proactive management, not reactive struggle. David and Emily continue to fund their 529 plan, building a legacy for their child. They report a reduced sense of anxiety about future college costs. The plan gives them peace of mind, knowing they are actively working to provide opportunities without burdening their child with massive debt. This demonstrates how tax-advantaged accounts don't just affect individual finances, they empower families, shaping generational well-being. Their consistent efforts exemplify how strategic planning transforms daunting challenges into achievable goals, securing a brighter educational future for their lineage. The real lesson from our investigation is clear: tax-advantaged accounts are not a luxury for the wealthy or an enigma for financial gurus. They are fundamental tools for anyone seeking to build wealth, protect against financial shocks, and secure their future. Their impact plays out in ordinary lives, transforming potential struggle into tangible security. The tension we built reveals the cost of ignorance and inaction. The truth is empowering: these accounts exist for you, designed to maximize your financial potential. The choice to engage with them is a choice to change your financial narrative. Now, the call to action is personal. Review your employer's benefits. Explore IRA options online. Consider an HSA if eligible. Research 529 plans for education. The journey starts with a single step, however small. Don't let myths or perceived complexity deter you. Your financial future, your ability to provide for loved ones, and your peace of mind are at stake. This report concludes with a clear finding: the opportunity to significantly enhance your financial standing is available. The decision, and the rewards, are now yours to claim. Act today, secure tomorrow. This investigative journey began with the silent erosion of wealth, a pervasive challenge for ordinary individuals. It concludes with a message of profound hope. The tools to counteract this erosion, to build and protect your hard-earned money, are not only available but designed for your success. The stories of Maria, Sarah, Mark, David, and Emily are not outliers, they are blueprints. They demonstrate that with understanding and intentional action, anyone can transform their financial landscape. The future, once shadowed by uncertainty, can become a beacon of security and opportunity. Your financial power is within reach.